Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Green Bonds and Climate Finance, a simple guide to sustainable investing. Tackling climate change needs more than good intentions. It requires money to fund real solutions. That's where green bonds and climate finance come in. Green bonds help raise money for eco-friendly projects, while climate finance drives investments that combat global warming. As the world faces rising environmental challenges, these tools are becoming essential. They're reshaping how we think about finance, connecting profits with purpose. Curious how they work and why they matter? Let's break it down. What are green bonds? Green bonds are changing how we think about funding sustainable projects. They're not just about investing, they're about making a positive environmental impact while achieving financial returns. Let's dive into their meaning, origins, and unique characteristics. Definition and purpose of green bonds. A green bond is like a regular bond, but better for the planet. At its core, it's a way for governments, companies, or organizations to borrow money to fund eco-friendly projects. These projects might include renewable energy, clean transportation, energy-efficient buildings, or initiatives to restore natural ecosystems. The key difference is that green bonds are labeled specifically for sustainability-focused initiatives. Think of them as a promise. Every dollar raised will go toward helping the environment. This makes them a popular tool for financing projects that actively fight climate change while building a greener future. Why are they so important? Without tools like green bonds, many innovative clean energy or infrastructure projects would struggle to secure funding. They bridge the gap between environmental needs and financial markets, making it easier for green projects to get off the ground. History and evolution of green bonds. Green bonds might feel like a modern concept, but they've been around for over a decade. They officially started in 2007, when the European Investment Bank, EIB, issued the first ever green bond, called the Climate Awareness Bond. Shortly after, the World Bank joined in, issuing its own green bond in 2008. Initially, green bonds were seen as a niche product. However, as governments and businesses began prioritizing sustainability, they gained momentum. By the mid-2010s, annual issuances skyrocketed as investors recognized the growing demand for climate-friendly financing. In 2023, the green bond market is valued at hundreds of billions of dollars globally. Institutions are now embedding green bonds into their larger environmental, social, and governance (ESG) strategies. This growth reflects a seismic shift in how the finance world approaches sustainability. What was once a niche is now a critical part of the investment landscape. Key features of green bonds. What makes green bonds stand out from traditional bonds? They aren't just about funding. They come with features that build trust and ensure transparency. Here's what sets them apart. Clear use of proceeds. The money raised is earmarked specifically for environmentally sustainable projects. Borrowers must identify and disclose these uses upfront. Transparency and disclosure. Issuers are required to provide regular updates on how the funds are being used. Reports often include measurable outcomes, like the amount of CO2 emissions avoided or renewable energy generated. Accountability. Projects financed through green bonds are often subjected to third-party reviews or certifications to ensure they align with global green standards, such as the Green Bond Principles. For investors, these features mean peace of mind. You're not just buying a bond, you're backing tangible environmental change. For issuers, they provide a way to demonstrate a commitment to sustainability while attracting eco-conscious investors. How green bonds work. Green bonds aren't just financial instruments, they're structured processes designed to ensure that capital directly benefits sustainability projects. From the moment they're issued to tracking their impact, green bonds rely on transparency and accountability. Let's break down how this works. Issuance process. Issuing a green bond starts much like a regular bond, but with extra steps to assure investors their money will support environmentally positive projects. Here's how it typically unfolds. Define the project. The organization, issuer, identifies specific green initiatives that align with recognized environmental goals. Examples include renewable energy projects, green buildings, or clean transportation solutions. Follow frameworks. Most issuers follow guidelines like the Green Bond Principles, GBP, which outline best practices. These principles emphasize transparency, use of funds, and reporting. Some issuers may also pursue certifications from third parties to validate their commitment to green standards. Meet regulatory requirements. Issuers must comply with local and international rules for bond issuance, ensuring the green label adheres to specific criteria. Regulations may vary by country, but the goal is always to demonstrate credibility and environmental intent. Bond pricing and sale. Once approved, the green bond goes on the market. It's offered to public or private investors, often attracting those seeking stable returns and climate-positive impact. By tying funds directly to green initiatives, organizations can appeal to environmentally conscious investors while promoting transparency and accountability. Use of proceeds. One standout feature of green bonds is the strict designation of proceeds. The money raised must finance projects that align with sustainable development. So, where does this funding go? Here are a few key areas where green bonds typically make an impact. Renewable energy. Solar farms, wind turbines, and hydropower plants often receive funding to replace fossil fuels with cleaner alternatives. Sustainable infrastructure. Projects like energy-efficient buildings, green urban planning, or smart grids create long-term environmental benefits. Pollution reduction. Funding might support waste management upgrades, improved water treatment facilities, or technologies that cut industrial emissions. Conservation efforts. Examples include reforestation projects, wetlands restoration, or initiatives that protect biodiversity. This targeted use makes green bonds unique. Investors know exactly how their money is being spent, ensuring alignment with their ethical or environmental values. It's more than just a financial return, it's a contribution to a greener world. Monitoring and reporting. Accountability is at the heart of green bonds. After the funds are deployed, issuers must keep investors in the loop about how the money is used and the results achieved. Here's how monitoring and reporting work. Impact reports. Issuers often publish regular updates, annually or semi-annually, showing the environmental outcomes of funded projects. These might include metrics like CO2 emissions reduced, energy generated from clean sources, or gallons of water saved. Third-party audits. Many issuers hire independent organizations to verify that the projects align with their green claims. Audits ensure funds are used responsibly and meet outlined objectives. Transparency in fund allocation. Investors receive detailed insights into how every penny from the bond is allocated, not just the broad project scope but also specific milestones. Why is this level of detail necessary? It builds trust. Impact reporting gives investors confidence that their money isn't just disappearing into a vague, green label but actively driving measurable change. Without this accountability, green bonds risk losing their credibility. Green bonds thrive on their commitment to openness. This transparency not only reassures investors but also sets a high standard in sustainable finance, ensuring that both the environment and financial goals are met. The relationship between green bonds and climate finance. Green bonds and climate finance aren't just buzzwords, they're two sides of the same coin when it comes to fighting climate change. Climate finance focuses on channeling funds into efforts that reduce emissions and adapt to a changing planet. Green bonds, on the other hand, serve as a powerful tool to meet these goals. Let's unpack how these concepts connect and why their relationship matters. What is climate finance? Climate finance refers to the money directed toward initiatives that mitigate and adapt to climate change. Think of it as the financial backbone that supports a global shift toward sustainability. These funds might come from governments, private investors, or international organizations, and they're allocated to projects that aim to slow down climate change or help communities prepare for its effects. So what does this look like in practice? It includes mitigation efforts, funding renewable energy projects, improving energy efficiency, and reducing greenhouse gas emissions in sectors like transportation and agriculture. Adaptation strategies. Helping vulnerable regions build climate-resilient infrastructure, secure food and water supplies, or develop early warning systems for extreme weather events. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.